Abby, you are going to start your Future of Global Economy course remote because of COVID, because of Omicron as well. When you get to Geffen 590, how will you lecture the business students? What will you bring to them different?
Well, Tom, first of all, thank you for inviting me to be here this morning. This, in fact, is the first time I've been speaking since my shift over from Goldman Sachs. I'm ecstatic about this change, moving to the Columbia Business School. And the Global Economics and Financial Markets course that I'll be teaching is actually a course I've been teaching for the past 8 or 9 years. I've been a longstanding adjunct at Columbia, and I consider it to be a great intellectual home. The course itself is a combination of theory and practice. I have the opportunity to teach with one of the wonderful tenured professors at Columbia, a gentleman by the name of Pierre Yared, who will be covering a lot of the theoretical macro, and I'll be talking about, well, what's really happened in the markets, not just over the last few days, but if you will, over the last several decades, trying to put this all in perspective for our students.
The perspective needed away from your prodigious math abilities is the new capitalism. Columbia Business School has supporters with names that we know on surveillance: Kravis, Cooperman, of course, the great gentleman from entertainment, David Geffen. How do the new capitalists and the budding MBA students, how do they deal with a new, more responsible capitalism?
Oh, that's a terrific question, Tom. And let's keep in mind that at Columbia, there's also this great legacy of intellectual capital. Some of the great thinkers in terms of capital markets in the 1930s and 40s also had relationships at Columbia, strong economics department, strong finance department, people like Ben Graham, for example. And so what I see in the new students is really quite interesting. At Columbia, about half of the students in my course are in fact non-Americans, and they bring an incredible global perspective to what we're seeing. You know, very often when we look at structural change in the United States, we say, oh, nobody else has ever dealt with this before. Well, we are actually incorporating the experiences of our students as well. We do find that this generation of students is very much interested in a few things. Number one, they'd like to know how companies run, obviously. In our course, we also talk about how government policy is made, and we give the students opportunities to debate what should those policies look like. And among the topics we addressed, of course, are things like ESG, but we also look at things like regulatory changes, things that might need to be adjusted as the structure of an economy changes. And of course, I always love to talk about the fundamentals, the data in the economy, but also the valuation of the markets. And when I say the markets, it's not just equity, it's also fixed income.
Right. Lisa Bramlett, you know somebody in row 7 is going to stand up and say, hey, Abby, what do you think of the market? I mean, that's where this is going.
And so I'll do it. I'll stand up in row 36 and say, we just got this PPI data after yesterday's CPI data. We're now pricing in about 4 rate hikes. We're in a new regime for inflation. What's the market call at a time when most strategists are bullish on equities?
Yeah, I think, in fact, the regime change, Lisa, occurred a few months ago when we began to see data suggesting that inflation was rising, that interest rates would be moving up. And underneath the surface of the market indices, we have seen a great deal of action. Obviously, the rise in volatility, but we're also seeing that investors are starting to move away from the big mo. And that big mo for many years, of course, was fixed income, buy bonds, regardless of the interest rates. We see that investors are becoming much more selective in fixed income. And of course, we see that in equities as well. The thing that is always so important is what's already baked in to expectations. My feeling is that we have a few surprises ahead in the equity market, some good, some not so good. But the key for me is always the valuation support. And that valuation support is not particularly good in some segments of the market. In some, it looks pretty good. There are some growthy areas that are not yet priced excessively, but the overall market, I think, will be volatile because the only valuation metrics that still look appealing are the ones that are linked to low inflation, low interest rates. As those continue to move up somewhat in 2022, the equity market comes under some pressure. I think PE ratios for the overall market compress somewhat. I think there's some offset in terms of continued improvements in earnings growth because I certainly don't see a recession. So I think the real action in the market is going to be under the surface, not so much in the indices.
And based on that, this idea of the action under the surface, how much of that is pricing in a perfect transition to a tightening cycle? This idea of an exit and threading a needle that by all accounts is going to be tough for the Fed to do.
Well, you raised two very interesting points. Number one, the needle that the Fed has to thread, and they'll be doing it through a combination, I believe, of increases in short rates, but also adjusting that balance sheet. Could there be another temper tantrum? Maybe, but I think the Fed is actually doing a great job by signaling these things ahead of time. You know, when I started as a junior economist at the Federal Reserve Board in Washington, the rule of thumb then was you didn't tell the markets anything about what you plan to do as policymakers, and 2 to 3 months later, you'd start to tell people what, in fact, had already happened. That's not the way it works now. I think the signaling that gets done by the Fed is actually very, very helpful in that regard. So that's one needle that has to be threaded. I think the Fed has begun to do a very good job. The other needle that has to be threaded is how to position portfolios. And I think that institutional investors have been talking about this. They haven't been doing it. I worry much more so about individual investors, many of whom haven't yet figured out the damage that could occur to their personal portfolios as interest rates begin to rise. And that to me is concerning. And so when we think about, shocks to the system, when the valuation support's not so good, we can't assume a smooth transition. There are some risks out there that could knock us off balance. People talk always about the pandemic, which is not over. We need to worry about what's happening in other countries where vaccine distribution has been quite limited. We also need to worry about a disruption in fixed income markets and what that could do. And I know that there are some people out there who are concerned about what happens when people recognize that there's now been this big difference between cap market performance and equal weighted performance.
Abby, in the Geffen 590, when they ask you for your market call, just tell them yield up, price down, and leave it at that.